So I had, and then Urtex had a good question that I wanted to go over. Maybe we'd wait for him to hop on if he's gonna hop um, on using when to use study price overlay, Sierra's study, versus when to use our overlay. And I guess I'm recording it, so even if he's not here, I think we can go ahead and get into that if he comes on. If he hops on later, and maybe he can clarify some things, but about his question. But let's go ahead and look at that. And then I've got some fun stuff to show y'all with this idea of Vespa Trade saying, let's take this stats machinery that we were playing with last time around the prop simulator and just use it for analyzing our output here from the stats collector. So getting things where we can get visualized returns over time. And I had, you can do things like this in Excel, but it's nice here. I put this out. This is also on my GitHub. I can share it in the Discord or on Twitter or whatever for those who are interested. And of course, always want any feedback or contributions y'all want to make. I can always use help on stuff. The but this is we'll go through these, and I can look at some of these metrics and whatnot with you guys and talk about what they mean if you want to dive deeper into any of it. But just another tool for taking our stats collector output and analyzing this stuff in ways that are hopefully getting helpful metrics, helping you analyze the characteristics of your sample of trades, looking at what the randomness looks like there. What can you say about it? But I think the first thing to do is, yeah, Urtex had a question, and if anyone else has questions on kind of prop alpha tool stuff before I hop into the prop alpha adjacent things, let's say, we can do those. So he had a question which is basically overlays. So we've got a study which is signal overlay. Signal overlay is an adaptation from another one of I kind of redid internally one of Sierra's studies, but the idea there is for our LTF delta pivots and HTF the HTF and LTF delta P to P. You want to use that because when you're overlaying from, let me go ahead and put this on let me set up those charts or one of those. So when you're going from a lower time frame chart to a higher time frame chart, Sierra's study price overlay does not have nice display features. And so some different logic is needed in this case. So if I put on, let's do the LTF delta P to P here, right? And so we're highlighting these the blue, white, yellow, the pivots here on RTH Asia Euro session, and then we're gonna go to let me make another chart, and let's get rid of this study here, and I want to make this I don't know, let's make this a 1 hour chart, and maybe we can let's put some more days on this guy too. Oh, you know what? I probably have the fact that I made this from scratch. Yeah, here, let me change this. We'll make sure the session times, we'll make sure it's a 24-hour chart for these guys. Otherwise, I'm not sure it's correct. Okay, I'm not sure what that changed, but you definitely want these to be the 24-hour chart. And same thing here. Let's go ahead and do that. The 1700. 1559.59. All right, so this is where you want to use our signal overlay. And you have to use, unfortunately, you have to use let's see. So I want to do this line. Okay. So Asia session is, yeah, is actually the white one there. All right, and then we're going to duplicate this and do overlay of Euro pivots. And then let's change the color here to yellow. And then we want to do overlay of RTH pivots. All right, so these, again, this study, the signal overlay is specifically designed for this study and the HTF equivalent. If you use Sierra's study price overlay, you're not going to get to see it, like, certainly not like this. I think but Sierra's, so the question is, when do you want to use Sierra's overlay in particular? And that is when you're going from high time frame to low time frame overlays. Low time frame to high time frame, it depends on what you're doing. It's if you don't see what you want to see with ours, try Sierra's. It might work for your application. We could play around with this right now and actually just see what do Sierra's look like instead of this if we tried. Let's try. Why not? Let's do study price overlay. Now you got to be careful also overlaying volume charts to time charts, because you're going to get some goofy things. Sometimes it's a lower time frame, sometimes it's a higher time frame, because volume charts in the overnight session where volumes are low end up being effectively high time frame, and during RTH they can be quite low time frame when volume's high. So let's just see. Let me turn these off. Let's see. It's gonna be something weird. Okay. Asia. Let's see. Let's do. I think I had Asia was white. Euro was yellow. And RTH was a line. Okay, so why is RTH not showing up? Yeah, so you get some so sometimes sometimes RTH shows once in a blue moon it shows up. So maybe I zoom in more and I can get more. Yeah, it's very, like, you could tell it just doesn't it's super wonky. It's not clean. It seems to be jumping all over the place. It doesn't seem to pick it up every day. So there are all these problems with this overlay specifically. I think the issues I have with Sierra's overlay tend to occur when I'm going low time frame to high time frame. If you're going high time frame to low time frame, you absolutely want to use Sierra's study. Now, again, it's worth playing around with ours, seeing what it does, what the difference is. But if I'm going to take let's go to slightly higher. Let's go to something that's 4 hours. And let's do something like a moving average. I'm going to put a exponential moving average on this guy. Let's see, moving average, exponential. Let's just do like that. And then I'm going to overlay it here. So I'm not going to use ours here. I'm going to use Sierra's. I'm not even going to mess with ours right now. So let's see. Let's do chart region 1. Okay, and so with Sierras, the thing that you've got to be careful of, I've gone over this many a time, and probably on another recorded stream here, that the thing that you always want to be careful about is when you're overlaying high time frame to low time frame, particularly on Sierra, you want to make sure that you're not creating look ahead bias. So we can try to, let's see, my guess though is that this, let's see, this value 178.50 being from the period starting at 11 a.m. So there's something off too on Sierra has some options here, so you may want to play with this as well. So you can latest value from corresponding time, earliest value from corresponding time. You've always got to do a sanity check on these things to make sure that you're not. So here, this would be the 9 a.m. bar. But this is the close value of the 9 a.m. bar. I almost guarantee it. So again, you get the 9 a.m. 4-hour bar, 181.25. Let's see where this was at the 9 a.m. bar was. Yeah, basically 181. It's gonna be right there on that guy. So that's that value. We didn't know that value until that bar closed. So if you're using that, you're gonna get some insane Sharpe ratio on whatever strategy you use, trying to target that or whatever. Or using that as your trend filter, like oh, the trend is amazing because we're above, we're above this value. You didn't know what this value was until here. So you got some look ahead bias that you have to worry about that. So which is exactly why we put in this lag study, signal lag series. Again, I've gone over this on stream before. I'm sorry if it's old. It is worth going over there though, because again, Sierra gives you enough rope to hang yourself with on this amazing freedom they have on their studies. There's this amazing flexibility in Sierra, but at a cost of, unlike with TradingView, which is nothing in comparison in terms of functionality, but TradingView enforces on their studies that you can't do look ahead biasy things, whereas Sierra definitely lets you get yourself in trouble. So you have to be careful with that, but you would want to overlay instead the signal lag series, which fixes that problem. So that's, I hope Artex gets that on the sees that on the recording. But that's basically the high time frame to low time frame. Use Sierra's steady price overlay. Low time frame to high time frame, I'd say use ours, but it's going to vary on application. Ours has the nice visual features. We get the lines here connect on the low time frame P2P and HTF P2P studies. But if you're looking at something, if you're looking at a granular execution signal overlaying low time frame to high time frame, I would ask you probably why you even want to do that. In most cases, you probably just want to be executing on the low time frame chart. But if for whatever reason you want to visualize lower time frame signals, if where they are matters, it's not a chart drawing. This is not a chart drawing. So whereas if it's a chart drawing like our signal clusters or whatever, then let's overlay the drawings. That's what you would do there. So does anyone else have any study specific questions or questions about the software, chart books, anything that I can help with? Otherwise, I've got some things that I wanted to go over with you guys that are, I would say, again, prop alpha adjacent, like this prop alpha stats code that I wrote here, that again is on the, I'll post the GitHub link for people who want to look at it there. I don't know that I have nice comments yet on using this. It's not the cleanest code in the world. but it's, let's see, let me just do,
Hey Ranger, can you hear me?
yeah.
Hey, I looks like I think I missed the signal lag series discussion that you had, and then it's like the recording was missing. Do you mind quickly going over that, if you don't mind?
Oh, it's just what I just said was this was the signal lag series discussion. Is basically so the signal lag series. If you've got a high time frame signal that you want to use on a lower time frame for really anything, right? So the classic example would be I've got some kind of a moving average. I've got a trend filter that I want to keep track of the high time frame trend, and then I want to use that high time frame trend signal to decide, whether or not I should be trading on my low time frame. And you're going to gather stats on that and whatever. And if you don't use our signal lag series, the overlay is going to be look ahead. Like you are going to have look ahead bias. It's like absolutely. And Sierra's not, there's no way you're going to know that from Sierra. Now you could do, it's probably going to be fixed. You're not going to have an issue if you do chart replay and backtest stuff with chart replay, but good luck on that. That's an absolute pain in the rear. So if you use our stats collector stuff though, you're gonna be having a problem because you're gonna see these values as they are without the lag, right? So you're gonna see these are gonna be off by one period. So this is gonna be this value. You didn't know that this value was this value until here, but Sierra chart shows it to you like you knew it here. So that's why you got to be careful on, and then again, you can find some amazing backtest stuff when you're using very subtly look ahead bias things. I can't tell you how many times I've gotten super excited about a backtest and realized that I had some subtle look ahead bias in there, which again, Sierra will let you do. But so that's why we made this signal lag series. It was a trivial study. It's like literally the code is just look at the last bar instead. I don't know why Sierra doesn't have something like that, but you can offset it by more if you want for whatever reason. You can look 2 bars back, shift. It's a shift, and really 1 bar is all you should need. And here we're just again taking this high time frame moving average, shifting it back by 1 bar to get rid of the look ahead bias before we overlay it to the low time frame chart. So again, if you're using any sort of a high time frame thing, now one of the things you might also want to do with like a high time frame signal is, if you're getting, I would say in so let me say this is really for back testing. If you're doing something live, now live Sierra is going to be giving you correct values. So if you're trading this live, you can get rid of this. Um, oops, let's see. Let's unhide that one. If you're trading this live, use that's what happens when you dereference that. If you're trading it live, use this. Use Sierra's because it's going to give you the up-to-date value. But if you're going to backtest, if you're going to be referencing this at all back here in any sort of meaningful way, you have to lag it. So that's really all there is. That's all there is to that. That's why we made that study. It's really for any backtesting overlays from high time frame to low time frame. Now, are there any other? Yeah, does that answer your question about that? Is that clear?
Yeah, yes, Ranger, thank you.
Okay, cool. All right. Well, yeah. If there's any other Sierra questions, let me know. We can always go back to that. Otherwise,
I
yeah.
I had a well, just could you talk a little bit about the either or study that you recently added?
Oh, yeah. Totally. Yeah. Let's do that. Let's clear these off. Let's go down to let's go down to 375 volume chart for this one. This one's pretty cool for. I mean, again, this is something that I made because I was getting because I was wanting to use signal clustering on buy and sell signals. because I want to use signal clustering for areas where let's do. So I was doing this with Delhi, and let's throw Delhi on here. And what I was doing with the Delhi study in signal clustering is I was cranking the standard deviations way up, so like 3 or 4 or whatever. And then I was saying this has to be a really extreme anomalous delta little moment, little bar. And then I was using the signal clustering. But the problem I was running into was with signal clustering. I was saying, okay, well, what if I actually want all of them? Like, what if there was a cell impulse that lined up with that bi impulse? I want to say that's a meaningfully anomalous delta level. But here, if I don't do anything else, I'm restricted to just doing, I could do these would just be, bi-signal. Oops, let's do it like this. You could do like bi-clusters, and then you could do um, cell clusters. Let's see if we have any cell clusters. Oh, yeah, you do back here. So let's overlay it too. I just want to see how it looks. Chart drawings. So then I think someone was asking earlier this week about this study, and I unfortunately do not have it with subgraphs for testing yet. It's just a visual study at the moment. So I hope to make it with some sort of testability, but for now it's just visual. So we went over that a little bit last week about why to be careful about that. Um, but because of that, because I thought, okay, well, I think it's actually meaningful that it's not just a. What if I want to combine these? I didn't have an easy way to do that, other than I could go in and try to add another subgraph in here, which is annoying and was causing problems when I did it for people with the delta anomaly, the anomalous delta by price. When I added in another subgraph, like there was a fourth subgraph here for just a second. I pulled it back out because it was causing some problems on stability. So what I thought was just like we can make this a lot easier. I can just do this. I can just make an either or study, which either or will mean that either signal one fires. So either it's a buy or it's a sell, and I don't really care which. Now, weird niche thing, because usually you should care what's going on there, but this was very much for this specific purpose. And the other thing I could think of using here is like anomalous delta by price, or with dynamic delta pivots, the sort of up pivots, down pivots, clustering those as well. Although dynamic delta pivots does actually have a like a there is a I didn't have a problem with this. Dynamic delta pivots does have a all setting there, but
I
you could. What's up?
I had another hypothetical use.
Let's hear
What
it.
what if okay, so you have uh, a signal and you want to filter it by trend. And so, what your trend filter is like -1 for downtrend, 0 for no trend, and +1 for positive trend. So you're looking for this signal, and you create a signal combo of the signal fires and there's no trend, or a signal fires and it's a positive trend. So those are the two times that you want to like act on your signal in like a positive direction. Or vice versa, a -1 or basically you want to take either signal when it's neutral or the corresponding direction if there's a trend one way or the other. So like in the stats collector, you know, on bar close, if the signal fired with neutral trend or trend in the same direction. So like you're taking
I
either.
gotcha. I gotcha. Yeah, yeah, totally. No, that's a great use case as well. I hadn't thought about that. I
Like
totally.
it's literally a logical or, right? Just
Yep,
like you would do an alert filter.
exactly. Yeah, exactly. Yeah, and I just there wasn't any like couldn't think of any nice like Sierra endogenous like Sierra didn't have anything to do that other than yeah you could use a, color bar alert and put an or in there, and this is basically like that but without the annoying bar look back restriction that you get on color bar alert.
You
So
could
the
also
reason,
make like an exclusive or,
oh
so it
yeah,
has to be one or the other, not either.
yeah, not if they both fire at the same time or whatever.
Mm-hmm.
Um, yeah, I could make that a switch. I would wonder. Yeah,
I
on there
can't
I
I,
could.
I can't think of a use case right now,
It would
but
have to be something like. Yeah, I would have to. I'd have to think about that. It'd be easy enough to put in though an XOR. Um, but let's see. I don't know what's going on with this study. Maybe it's because the cluster grouping width is too wide. I gotta think. I gotta think. Let's see what is going on here. Remove signal either or. It's because I didn't plug anything into it. Sorry. But yeah, I love the trend the trend following example for the people who didn't get that. You frequently would have uh, there's positive, there's an uptrend, there's downtrend, or it's neutral. We're in a chop zone, and then you want to filter a signal with you know we're in trend, but also you want to take the signal when you're in the chop zone. So you you can use that either or to go to pull that out. Now, of course, you could do depending on how you were doing it with because I think on our filter, I think you're right. I think that's the only way to do it because with our filter study, um, I don't have a non-positive, non-negative option. So you would have to do you could flip it around. There would be annoying ways to do that without using the either or signal and using the filter, but it'd be kind of backwards and unintuitive. So I like the either or as a solution in that case, where you'd want to take the long if it was either chop, not a trend, or in positive trend but not a negative. So and then to be able to see the stats on that. So I appreciate the new use case there because really I was only thinking about it for this very specific clustering application. But is there anything y'all got any other Sierra Prop Alpha study thoughts, questions? We could do. Let's see. Let me see then, because I want to show you guys this. Now again, this needs some work. Ultimately, the same thing. I hope I can get some Vespa input on making a front end for this. But what we've got here is this is inspired by that prop simulator of taking the option to take the empirical distribution of your trades from the this is the stats collector output, but you very much if you have your own trades as well, max opposite excursion here is actually optional, so you don't need that data. You can get it from Sierra for yourself, but you want if you got a date time and you know what your return is, then that's good enough. And you can feed that into this program, and it will output very quickly. Do the same sort of it'll run all these stats. Now this is not doing Monte Carlo simulation with your trade data. This is just a pure, this is a runs through it once and is getting things that you see in both in the stats collector, but some sort of more stuff outside of it, as well as giving you some visualizations of different things. But I get some of the things that are common with the stats collector, again, sort of cumulative return, number of trades, mean, median. We're not doing median in Sierra, but whatever. I got median here. We talked about these last week: mean absolute deviation, median absolute deviation, standard deviation, so on and so forth. So these are the per trade results working, and I put a multiplier in there. And this guy, I've got to make a nice format for it, but this one's, I put a multiplier of 20 in because this is NQ trades. And forgive the weird visual scroll there. So, but anyhow, this is basically stuff with some exceptions that you get inside the Sierra study. And some of this down below is in the Sierra study as well, like number of days. And I'm not sure if we're measuring, I'd have to look. I think the skewness and kurtosis that we're getting in Sierra is at the daily level and not at the per trade level. But I mean, those are sometimes meaningfully different. Depends on the strategy that you're trading. But trades per day, you've got I'm sort of looking at one of the interesting things with markets is you can have coin flip bracket. You have bracket based trades, which should generate a nice normal Brownian motion, but because of trade frequency can increase really rapidly sometimes with markets. Sort of the time, there's some sort of time dilation which you see on these volume charts as well, is that RTH time effectively moves a lot faster than it does in at night in Globex. And I say that because the pace picks up, and because the pace picks up, all of a sudden these things that would be nice little coin flips that should generate a nice Brownian motion on a simple bracket, you get lots of you can get like an extreme number of trades in a day, and that all of a sudden brings your sort of the distribution at the level of daily trades, and now it turns into something very fat tailed and wacky, and it really ends up being because of the trade frequency. And trade frequency is also something you should care about if you're trading intraday, because that's where your costs are really going to come from. I mean, this it depends on the product you're trading. NQ and ES are very forgiving if you're trading UB, especially if you're scalping UB. Really unforgiving on that one, and you can really think about do some math on how much crossing the spread and paying the per side costs really can cut into your what's the sort of profitability hurdle you have to jump gets a lot higher because of trade costs, and trade frequency is one very easy way to look at those costs. So then we've got daily statistics. Again, some things that I have in the back tester, and some things that I don't. There's some other metrics. We do show Sharpe ratio in there. We'll talk about that in a minute. And here's two others that you may find interesting: Calmar and Sortina. Other less frequently used ratios that people like, and then drawdowns, about what's your max drawdown, and then the average overall of your drawdowns. There's some questions about like what. I was actually going on a wacky math rabbit hole today on just for Brownian motion, like give me the probability distribution of max drawdown over a period of time. It's pretty nasty to calculate. I was seeing some claims on FinTwit. Somebody was talking about, oh, this is fat tailed and infinite variance. So don't put too much like statistical stock on that. But I think that can be said for a lot of things in the trading space about like he's going off on why Sharpe ratio is great, but max drawdown is unstable, and I can see why this is worse probably, but there's you know. Uh, I'm sure the stability of convergence a convergence of law of large numbers on Sharpe ratios also maybe up for question on some strategies. And there are notorious examples of like long-term capital management which went bust, had an amazing Sharpe ratio really up until it went bust, because if you're running a negative skew strategy like selling out of the money puts or arbitrage strategies, you don't see you don't really see how bad your downside is. You can hide that from yourself for quite a while. So carry trades sort of the same behavior, is that your in sample max loss is not a good representative of your downside risk. Let's say it that way. So, but for those, and this is one of the things I wanted to talk to you all about, is Sharpe and Kelly Criterion and stuff like that, because I think this is a you hear about this a lot, and I wanted to go over. This is basically, so for those of you who don't know, Sharpe, and I want to annualize it, but you want to take your R. It's always written as like R over sigma or mu over sigma. So where R um, is your mean return, and sigma is your standard deviation of your returns, and this is annualized. So what we if you get it, and you can't jump from per trades to you can't jump from per trade averages and per trade standard deviation returns to, again, this time factor is wonky, so you have to downsample it to days. So you have to sample your trades down to days, and then you can take your mean daily return and your mean and your sorry and your standard deviation daily, but then you have to annualize it. So then if this was a daily mean and a daily standard deviation, you would need to multiply it by basically 16, but root 252 or whatever would be your annualized Sharpe ratio. Um, and the reason for that is that standard deviation has a square root of a mean. So R looks like looks like 1 over n sum of little guys, whatever, daily of the your mean daily return would be your sum over the daily returns divided by the number of days, and your standard deviation would be square root of the average the average sum, and this would be a centered second moment, where that R is that guy. So you would make everything mean zero, square, sum the squares, and that 1 over n now is associated with the time, the number of days, and that has a square root factor there. So if you were to scale this up, if you were to add a bunch of, if you were to add, t days to it, make that a t instead of 1, make that a t. So R gets a factor of t out in front, and then the sigma gets a factor of root t. So that square root it comes out to annualize things. So anyhow, this will be your annualized Sharpe ratio. And why is that important for people in trading space? One of the reasons people like it, let me just clear this all off. One of the reasons people like Sharpe ratio is, one thing, it's very simple. It's a nice risk reward proxy. You could say, again, standard deviation being kind of how much wiggle do I have in there? What does a bad day look like? This is a good proxy for risk. Again, good proxy. Some people Taleb's books are good on that. Sometimes it's not a good proxy for risk. Again, if you're a long-term capital management, the that's a story worth looking up. Talk about people who definitely are drinking their own Kool-Aid. Very, very smart people who almost blew up the global financial system over something that had an amazing Sharpe ratio that they were just hiding a bunch of negative skew risk. So the Kelly criterion is what I wanted to talk about next. And for those of you who don't know, the Kelly criterion is basically expressed as edge over odds. Is that if you're bet sizing, so if you're using if you're taking stats on your stuff. Now again, you got to be careful. Stats, in sample, out of sample. You could do a lot of things to try to be more rigorous about that. Be careful about overfitting. Be sure that if something looks good, that you then look over different periods and different regimes, and preferably different instruments to see if there's some sort of robustness to it. But if you are let's say you are confident in your Sharpe ratio, then if you've got a strategy that's scalable that you could compound returns in, how would you want to bet size to get your best possible compound return? So the Kelly criterion would be basically like if you've got a return R with exponential growth properties. So let's say you start out with your initial capital S0 and your return R is your your geometric return you can get, then your bankroll ought to grow like like this guy, as t grows in time. So the Kelly criterion is basically saying, okay, how do I bet size to get the best possible geometric rate of return? And so what that looks like more specifically is a lot of times, here's the big assumption. The big assumption is that, let's say it follows your sort of return process follows a geometric Brownian motion. Which, what does that mean? That means it looks like this. It looks like some pool of initial capital times this guy. And I'll explain what this means in a second. Um, all right, and this is worth thinking about for a number of reasons. Again, even if this is a vastly simplified model, and actual things in financial markets are very much very strong differences from geometric Brownian motion, but I think it's a good model. It's a good, it's an intuitive model, and it bears thinking about, and a lot of people use it. But what this is if you've got a mean return of this is your mean return. This is a drift of your. This is the drift of your guy, and you've got a volatility. That's your volatility of your asset. Then you get a volatility drag term, which is this guy. And so this is basically your drift. This is the deterministic part of how your capital is going to grow, and this is the random part of how your capital is gonna grow. And this is B of t is a Brownian motion, so you just think of it as it's one of these guys. It's just mean zero, nice randomness. And but this again, volatility drag. This term is capturing the fact that if I make 5% and then I lose 5%, I have just lost a, then what is it? It's 1.05 times 0.95 is I've actually lost, then it's actually I'm out a quarter of a percent. I've lost a quarter of a percent. So there's a volatility drag, which is that if you're percentage wise, winning and losing, that's gonna take that volatility sucks some of your drift out, and so mu would be your drift, would be your mean return. So the idea here is you'd say, all right, so how do I want, given this, let's say I found these stats. This is my mean return. This is my volatility. This is how my geometric growth would look if I was able to compound my money in this strategy, based on again my Sharpe being mu divided by sigma. So how would I want to bet size? So what leverage would I want to use is what it's traditionally phrased as to get the maximal geometric growth rate. But what it turns out is you're going to put some leverage factor f here, which makes it your return is now f mu minus f squared sigma squared over 2. So this is your leverage, and we're just going to ignore this because it gets averaged out when you're looking to maximize this. What we're looking to do is we're looking to maximize this guy over f. So what leverage factor, given a mu and a sigma, right? Given a mean annual return and a standard deviation of annual returns, what leverage should I apply? Well, it turns out that the right answer is And on the money that I don't lever, I should put the rest in risk-free interest, a risk-free account. Turns out that if R is the risk-free rate, R star. Let's not confuse ourselves with this mean return. I'm just going to erase that, scratch it out. So it turns out that the right answer is mu minus, so R over sigma squared, which right now, that's maybe a meaningful number, but 5 years ago that was 0, and you could think of this as like mu over sigma squared, which is pretty, it's like Sharpe ratio divided by your volatility. So let me make a new one of these. And I'm going to say, all right, so again, we determined that the Kelly optimal leverage, so Kelly being what is my bet sizing? What should my bet sizing be? What leverage should I apply to my strategy to maximize my geometric rate of return? And now Kelly is very aggressive, and you probably don't ever want to bet full Kelly, even if you're totally confident in what you're doing, because you can bet fractional Kelly and still get some real benefits on geometric the sort of geometric growth of anything that's compoundable. Now, and again here, for simplicity, I'm probably going to ignore this, but it does matter right now. And because the risk-free rate is what it is, you probably want to be, what this says is be less aggressive. Um, unless this guy is just way bigger than the risk-free rate, which right now I almost guarantee you it is not. So, but what is this practically speaking? Okay, so how do I calibrate my leverage if I found that this was my Sharpe ratio, this is my mean and standard deviation? Well, it turns out that what you want to do is target volatility in your account. And the volatility in your account is just going to be sigma times F, which, again, ignoring the risk-free rate for now, I'm just going to say is the Sharpe ratio is just mu over sigma. So then it turns out that basically what you want to do is target a volatility in line with your Sharpe ratio. So, and this is annualized again. So if I had a $100,000 account, I would want to target an annualized volatility of, let's say, this is an insane number. Let's say I had a realistic Sharpe ratio of like zero point 0.8, which would be like on the very good end of realistic. It's like Bridgewater's Sharpe ratio over their lifetime is, would be, 80,000. And then I would want to target daily volatility from that. So this would be the annualized volatility I want to target with my strategy to maximize my geometric growth rate. And then I would say make it daily. So this would be annual target. And then the daily target would be this divided by 16, divided by that, root 252 or whatever. So 80K divided by 16 would be, I don't know, what would this be? 8 times 2. What would that be? What would that be? 5K? Is that right? Um, can I do math? I can't multiply.
Yeah,
I have a PhD in math. I
that's
can't do
right.
arithmetic.
That's right.
The
Perfect.
so that would be your daily volatility that you want to target, and the um, so then that would be basically, so then you would look at your daily standard deviation, say like, all right, pretend this is a Sharpe ratio of 8, but you would say, all right, I want to target 5K. So that means, if this is on one contract trades, scale your contracts up accordingly. Say, all right, I want to target 5K daily volatility. So I need to trade, I need to be trading at least, let's say three contracts. Maybe then I say I don't want to do full Kelly. I want to do fractional Kelly. So then I would cut that number in half. So let's say then I would just trade 2 contracts. So that's basically what that. So this is a way of backing into. All right, if I know my strat, Like if I know my stats, if I'm really confident in the strategy I have, in the stats I have, if I really want to compound my money at an optimal rate, again, assuming this is all a geometric Brownian motion, if you have a positively skewed strategy, by the way, that you're confident in the positive skew characteristic of, there's a cool paper out there by this guy Ewan Sinclair, is very legit options trader. Has some good books on options pricing and whatnot. Very much aimed at a sophisticated retail trader. That he has a cool paper out there on, if you have positively skewed strategy, you can afford to be a little bit more aggressive. Bet higher fractions of Kelly, and if you have a negatively skewed strategy, you should bet lower than your Kelly fraction, kind of more substantially. Better bet a quarter Kelly or something like that. So that's the Kelly criterion volatility targeting. And the one other thing I want to say about this whole thing is that you can actually get from a Sharpe ratio, you can tell what your expected drawdown ought to look like. You can basically, and this is one way with when if you get like a real, I tell people who get like real high Sharpe ratios and back tests. The nice thing about a real high Sharpe ratio is you can find out really quickly if it's wrong. And the thing is, the again, if this is my Sharpe ratio, this means that it grows like t times mu minus sigma squared over 2. Um, Another way you could also say, but let's actually look at it as, so let's look at it not with the geometric. Let's just look at a standard Brownian motion. Let's do this. So Brownian motion with drift. So let's say my strategy is just not even thinking about the compounding characteristics. That looks like this. So this is a Brownian motion. You can think of as like you frequently see something like this. So this is your random. This is the noisy component, and this is the deterministic component. This is the juice you got, and this is the sort of uh, you know noise you got to put up with that ultimately averages out. But you want to say, if I really have such a strategy, what drawdown length should I expect? Well, if I'm going to have a drawdown, it's because volatility on short time scales is going to overwhelm the drift that I have, the like sort of return predictability. So let's say I'm looking for what time scale t is this guy approximately equal to sigma square root t. So on this time scale t, there is a time scale where the volatility is dominates the, you can't see you can't see how good you are on short time scales. There's enough randomness there that you're going to run into drawdowns. And so that time scale is, do the division by root t on both sides. That is sigma over mu, which is 1 over Sharpe. And then what that means is that on the time scale of 1 over Sharpe squared is what you would expect your drawdowns to, the sort of drawdown length ought to be like this. This means on the time scale of 1 over Sharpe squared is basically how long your average drawdown ought to be. So what does that mean is, like, if you think you have a Sharpe ratio of, and now this is annualized again, so if you have an annual Sharpe ratio of 1, you can have a year-long drawdown. You can have an amazing strategy that has a year-long drawdown on average. But if you look at your back test and you say, oh my God, I have a Sharpe ratio of 5, then 1 over 25 of a year. So would be a so you better have a one 25th of a year. So your drawdown better not be more than 2 weeks on a strategy, or else you probably don't have a Sharpe ratio of 5. Now, the other thing we can tell from this is what the drawdown size ought to be. Is that what's your average drawdown size is again also something you see here, um, which is that if we plug in this guy to the this would be your drawdown component. So is that you can see that it's on the order of sigma over Sharpe is how bad your drawdown ought to be. So I hope that I hope that makes sense. And there's as a little bit tangential, but I feel like if you're going to meaningfully use these statistics to think about the strategies that you have, you ought to be using them to think about, again, with the caveat that be careful back testing, be careful, again, no guarantee, this is not trading advice, this is not money management. I'm not, do your own due diligence. But if you are confident in your stats, you should be thinking about what the implications are for sizing your trades, and what kind of, again, this sort of knowing what sort of drawdowns to expect, sanity checking the Sharpe ratios. I really think that if on these back tests, if you get something that's considerably above, if it's above 1, it's very, very good. And if it's above 2, I would double, triple, quadruple check it, because those don't sort of hang out for very long. It's very, very hard to find a real Sharpe ratio that's up at that level for, if you're pro, if you got a HFT, if you got, you can get these high Sharpe ratios, for sort of accessible retail strategies, again, for benchmark, long-term S&P Sharpe ratio is like zero point 0.4 annualized. That's also probably what long-term sort of trend following is I don't know, zero point 0.4 to zero point 0.6. And then you can put a basket of these things together and squeeze some more out of that. But again, it just high Sharpe ratios. The nice thing about things that look like they have high Sharpe ratios is, like I said, you can figure out pretty quickly if you're fooling yourself. So again, I hope the math is not too much and not too far afield. I hope that's useful, because I do think that, again, if you're looking at this stuff, you should be thinking about what it means, and you should be thinking about the implications for your bet sizing, and your trading. And again, the Kelly Criterion stuff is super, super important. I highly recommend. There's a good book called Fortune's Formula that's very much geared towards the non-specialist, about Ed Thorpe, who's still alive, who's an absolute boss, who started out, who's a math professor who started counting cards and blackjack and using the Kelly Criterion to size his bets. Got kicked out of all the casinos and then went and started an amazing hedge fund. And it's a cool story, and it's got some really good principles in there that I think y'all would find hopefully useful. So this stat stuff, I'm gonna keep polishing this code. I'm hoping this is again, huge thanks to Urtex for getting me to do this stuff, and this was his suggestion, and I hope that he forks the repo and does a better job with generating these pictures than I did. This is my crude. The output here will give you, another way of looking at the randomness you get on. This one definitely needs some help, but something nicer than having to do this painstakingly in Excel every time. And great idea, Vespa, and look forward to seeing what he does with it. And ultimately, hope I can get some of his magic on making this into a nice web app so that we can stick this on our site. So unless there's anything else, I don't really have anything else. I thank y'all for joining this evening, and I'm happy to answer any further Sierra questions or questions about this or whatever. Thanks for but thanks for coming out.
For sure, man. Thank you, Razor.
My pleasure.
Thank you, Reza.
All right, guys. Well, yeah. If there's nothing else, hope y'all have a good evening. I recorded this. I will. I'll post that up here probably tomorrow when I get it processed.
Yeah, appreciate it. The office hours are great.